Good afternoon to the CEMC community. This is Charles Anderson. I'd like to officially welcome you to our very first CEMC webinar series. Again, my name is Charles Anderson. I'm the co-founder of the CEMC and the CEO of Currency Capital. I'll be moderating today's topics on global economic shift and its impact on asset finance. Joining us from today are three powerhouse presenters and speakers from Genpact, Siemens, and Barclays. The webinar will be 1 hour in duration, and you can use the live chat window to ask questions. We're also going to have Q&A at the end of the session, and if you don't get your question answered during the session, just let us know and we'll send you a follow-up email with the response. So let's get started. So joining us from Genpact is Anu Sachdeva. She's a Senior Vice President of Banking and Financial Services with more than 25 years of experience across various industry verticals, including equipment financing and banking. She is currently leading the charter to drive innovation through a unique approach that combines commercial leasing domain expertise, design thinking, analytics, and digital technologies. From Siemens is Gary Amos. Gary is the CEO of Americas for the Commercial Finance Business Unit at Siemens Financial Services. He is a 20-year veteran of the leasing and finance industry and is currently responsible for the P&L of Siemens' captive healthcare and industrial asset finance businesses. He also leads third-party vendor finance platform for the Americas. Our third speaker is Sham from Barclays. He's a director of the Financial Institutions Group at Barclays, where he advises specialty finance companies and banks on mergers and acquisitions and raising capital across equity and debt markets. He has over 15 years of experience advising financial institutions, including commercial and asset finance firms, on a variety of topics. So again, today we're going to be covering really two main topics: the state of the global economy, the U.S. and its impact on fintech and asset finance. Then we're going to follow that with Q&A. Each speaker will have a chance to share their thoughts and insights on each topic. So our first topic is what is happening in the global economy, and more specifically, how are the EU and Asian economies impacting our domestic markets? Starting us off will be Gary with Siemens. Gary?
All right, thanks, Charles. Let me start the dialogue, I guess, from the standpoint of, the global Fortune 500. When we look to that area, we see, two main countries driving that the Fortune Global 500, U.S. and China, making up almost half of those Global 500. And within both of those countries, there's probably two factions, two forces that drive it: manufacturing and service sectors. And I think each is equally important to maintaining the global economies, both domestically and internationally, as they contribute. But I guess for us, and where we see it is that we look, I think, more toward geopolitical landscape and what are the influences. We sit in probably 14 countries from a financial services standpoint, so we see and get a lot of feedback on local economies as it plays on the global stage. So outside the global 500, let's look more toward geopolitical landscape as it relates to, let's say, Germany. In the last couple of weeks, we've seen some unrest. We've seen what is a new administration that's carried over, but with really, I guess, less backing. So, the previous administration and where they're headed and their influence on the EU from an economic standpoint, they've lost a little bit of the backing of the coalition. Germany's a big driver through the EU. So for us, we continue to see a little bit of trepidation, moderation across all the large global economies and the countries even that we operate within. Point to the G7. The base of manufacturing in Japan now is inverted to, let's say, the UK within the G7. UK is dropping, Japan is advancing, and again around the manufacturing side. But none of it really speaks volumes to explosive growth or significant contraction. Again, tepid moderation and a little bit of ambiguity. So how long will, the overhang of Brexit as we see it, how long will it magnify the uncertainty? Where will it take us as they contribute now outside of the EU? But let me come back to something I said early on. I think that's important in terms of, the two major countries in that Global 500. When we look at manufacturing, when we look at service economies, and most of our economic influencers in our large countries really contribute in those two areas. What we look for is, the service industries are going to be, fairly steady for the most part. Manufacturing in the Renaissance period now, going through yet another evolution in what we call Industry 4.0, cyber physical environments, running, machines, something that, man or woman used to do. based on performance-based outcomes. There seems of opportunity there. I think that will become more prevalent, will rise more to the surface, and I think could add a lot of stability within global economies and local economies that we all operate in. So I guess for me, in closing on this section here, we look at it from a lot of different ways, but geopolitical unrest and uncertainty in a lot of the major countries. EU a little bit, fractured in terms of the center and the driver, the overhang of Brexit, and now really where we look is outside the service industries, how does manufacturing stabilize? And it probably stabilizes around this Industry 4.0 and cyber physical environments.
Thanks, Gary. Incredible perspective. Henry, transitioning to you now, you have a very interesting vantage point with how you're sitting over capital markets literally in Manhattan, most likely today. What are your thoughts on what's happening in the global economy?
Yeah, Charles, thank you. Hi, everyone. I think what we see from the banking side is really increased nationalism, right, across the major developed economies, and that's introduced uncertainty into the financial markets. You've got rhetoric in D.C. here around trade policy. Guys have seen the news. I'm sure you folks have seen the news around these the CFIUS reviews of acquirers outside, non-U.S. acquirers looking to acquire U.S. assets, and some of those blocked deals that have happened. And then generally, us going out to the global economy, changes in tax code around inversions have really, really dampened some of the activity. So I think in general, increasing nationalism is causing a lot of uncertainty and volatility in the markets. Brexit, for example, last year really did caught the markets off guard, and I think the upcoming negotiations on the UK and EU can really have meaningful impact on those economies. Turning to Asia, I think most reports have slowing growth in China. The Chinese as well have focused on capital controls and really taking a review on some of the largest acquirers coming out of China, and that's reduced global activity further. And so, the counterbalance to that we've seen is Japan's economic policies seem to be taking some shape and some hold, and so perhaps the Japanese can come back on the global stage and sort of take up some of the transaction volume that we're seeing going away on the Chinese side. I think the biggest thing we see really around the global economy and whether it's risks or opportunities is the big unwind of central bank policies that really propped up the economy post the credit crisis. And whether that's interest rate cuts that had happened, quantitative easing after that, Fed balance sheet, all of that unwind is going to happen shortly. And frankly, it's unprecedented in its nature and its size, and so I think the market is yet to really understand what's going to be the impact of this unwind.
Thanks, Henry. Transitioning now here to Anu. Anu, you sit at the top of a global finance and technology firm. What are your thoughts on what's happening in the global economy?
Thanks, Charles, and very interesting views both from Henry and Gary. So look, I think from where we sit in and see, and specifically looking at how it impacts, more of the leasing industry, for us, we see that, the advanced economies for sure, they will grow, but obviously at a modest, growth rate, probably 1 to 1.5%. And emerging economies will likely grow at a pace which is going to be higher. And clearly the equipment finance sector will see some amount of momentum which will build up. And that's what we see coming in from investment coming in both at a federal and state level across industries, whether it's mining, whether it's construction. So we are seeing a modest growth across US, Europe, and Asia.
Thanks for that perspective. And drilling, that's a good segue into our next portion here, which is talking about the U.S. economy. I think there's a lot of noise out there, and I think one of the most fascinating things about the equipment finance sector is, at least from our opinion, is a very human expression to where people are placing their bets, if you follow where people are spending their money on their equipment. So Gary, if you can kick us off with the next session, please.
All right. So I think, from this aspect, let's quickly look at the GDP chart, and then we can move away from that. But the next slide there. The numbers are the numbers is typically, the way, I approach these things. And is it flat? Is it moderate? It's probably more moderate than anything when you look at real GDP, when you take in the sensitivities and the analysis that takes into account, inflation-adjusted numbers. There's nothing here that tells me that there's a huge surge or there's a huge slowdown. I'll approach this really from, I guess, maybe a different point of view or infuse some different type of thought. I'll come back to the term of manufacturing or the thought process of manufacturing versus service. And when we look behind the numbers, which I think is what we all need to do in the asset finance sector, and really find the seams or the opportunities that we can exploit to help us manage our business through these cycles, because that's what you're going to see in any type of chart like this. And if we can pivot forward to the next chart, I really can kind of drive this home. So when we look at the slowdown, what are the forces of change? What are the trends? And there's a lot of influences across the whole transom. But let's look at it like this. In order to manage through the cycle, and as I said, exploit some of the seams of opportunities, what are the catalysts from customer expectations that will help us drive and maintain? Well, I think what we see through this whole industry, not just, me or Siemens, solutions and performance-based outcomes. In healthcare, we see things like MES and managed equipment solutions. We see performance contracting in the building and technology sector. Smart cities, a very large term that's used, again, across all industries, but more primarily in larger cities and how they're evolving. And smart grids, how can you energy source in different ways, whether it's renewables or other types of energy, how can you manage that vis-a-vis a smart grid? But all these things that we talk about are catalysts and solutions around performance that meet customer expectations, that whether we're in a down period or an up period, and we can continue to look back, but I'm choosing really to look forward past some of the GDP numbers that we show and find where those seams of opportunities are. I think that as we look at this, you can look at the economic factors as well, and what's pervasive there and what's obvious is fiscal policy is always going to drive and influence access to capital. We see that right now, and it will continue to happen. The Fed will continue to adjust the rates. They'll come upward. They'll try to offset any types of inflation, but at the end of the day, they're going to influence our access to capital. And I think finally, the larger, more looming topic for all of us as individuals and as businesses, is healthcare reform. Uncertainty. Every year, it seems like whichever administration, pick the flavor of the day. We all know a lot about healthcare probably on this call because we use it every day, both as consumers and within business. But we as the U.S. have the largest spend as a percentage of GDP around the healthcare sector. And while troubling because we are an advanced nation and advanced economies and we have advanced medicines, it's also a big part of our spend. It affects not only GDP, affects us personally, and affects us in the business sectors as well. So I think some of these influences, it's wait and see on the healthcare piece. But again, I'll come back and kind of close on this topic of if we look at customer expectations, if we can find those catalysts, we can look at the GDP and we can together as an asset finance business find those seams of opportunity and exploit them in the markets I spoke about, delivering the products and the outcomes that I spoke about.
I think, Gary, everybody would agree that customer expectations are shifting and evolving right now with the impact of technology and the global uncertainties. Henry, what are you saying from a banking perspective with respect to the U.S. economic slowdown or lack thereof?
Slowdown is an interesting term, right? I think that we, based on Gary's chart and some of the work that we've done here, we've definitely seen that inflation is not really hitting Fed targets. It's not really getting to the level that I think, the Fed expects. From that perspective, we've been in a bull market for a long time, and frankly, to share a short anecdote, a couple of meetings and conferences I've been to a couple of years ago, all the commentary was, what inning are we in, right? What inning are we in? Do we think the bull market's coming to an end? And I don't hear that as much anymore because I think there is some expectation that while growth is not going to accelerate or that much, it really is tepid and is really sort of flattened, if you will. I talked about the impact from Brexit and the China slowdowns. I think we've seen that reduce trade flows and cross-border M&A activity. We've seen the U.S. capital markets have fewer issuers in general and more companies tapping private markets, staying private for longer. You can read every day that there's less IPO activity. but at the same time, demand from investors is still very strong, right? There's a lot of capital to put to work from the investment community. You see it, you hear about it in the assets under management that many asset managers are building over time, especially the passive investments. And they just need to put money to work, and there's less issuers issuing paper, whether it's IPO, debt paper, or otherwise. We're seeing delinquencies across some of our clients in consumer credit ticking up. On the commercial side, on the asset finance side, we've not really heard too much of that from clients. And so I think that, if the consumer wave continues to trend further with delinquencies, you might see some of that push further into the commercial side. But ultimately, unemployment is still very low, that's another indicator that, this may be a slowdown, but not yet a bear environment. I think the key trends to watch for are, further risk appetite from banks, right? The banking system's gotten pretty healthy, but the ability to put loans to work hasn't, they haven't really fully put loans to work yet across different consumer and commercial products. We'll have to see if the current administration is really going to take a relaxed stance on financial regulation. And I think, some appointments need to be put in place for that to happen, and we'll have to see if those appointments go through. Obviously, all of the news is tax reform. That's what a lot of corporate clients are waiting on, tax reform, and then further rate hikes, right? Are we going to see further rate hikes? What's that going to do to the banking system, and then what's that going to do overall to the economy?
So, Henry, coming back to you here in a minute, and you had a lot of great points that are going to segue right into the fintech conversation, because I think we're all seeing flight to quality, flight to at least the desire for yield, the desire for liquidity, which are almost at opposite ends of the spectrum. How are you seeing those factors is the U.S. economy slowing down or not, impacting the consumer finance space, continued performance in the asset-backed space? How is that impacting fintech growth and asset finance?
Sure, I'll tackle that sort of two different ways. One I'll tackle via the bank environment, and I think it's a very important environment for the fintech space in general, right? It's just the relationship between banks and fintech and asset finance are they're often either joined as partnership or complementary or adversarial in certain regards. And I think that the health of banks has made it an interesting and different asset finance and fintech environment. And what I mean by that is that U.S. banks have been, they've become a real key player here across both spaces, and I sort of am taking fintech and asset finance separately to a certain extent, but they've gone from, talks about fintech sort of really changing the bank landscape to now banks partnering, I think, with a lot of the fintech environment, right? And whether it's by actual signed up partnerships, or whether it's by banks making investments in fintechs, or whether it's by banks becoming customers, of fintech products, I think we're seeing a lot of the health in the banking system and the tepid loan growth that I mentioned before really allow them to become partners with the fintech environment, with the fintech players out there. For example, Barclays, the way we play fintech, frankly, is through our accelerator. We run an incubator, and what we do is for some of our graduates of our accelerator, we become customers of those companies. Other firms have acquired, other banks have acquired, fintech companies or partnered, as I mentioned before. I think from an asset finance perspective, some standalone firms have had some difficulty sort of, competing, I think, at the higher quality scale on the commercial side with the banks, given, again, the health of the bank balance sheet. And with deposit pricing not quite ticking up, it's been tough for what we've seen standalone asset finance firms. All that being said, with rates rising, deposit rates are going up. It's a big focus of banks is on deposit rate, and as that deposit competition comes in, I think the standalone asset finance fintech firm can stand to benefit a lot. Separately, I think just on fintech itself, outside of the bank space, we see in some of the conversations we have, the fintech seem to be going through a second phase of its life, if you will, right? Going from more of a explosive growth, customer growth, origination growth, focus to really an internal focus on development of systems, processes, otherwise, to really catch up with a lot of this growth. So I think it's a healthy part of the natural cycle, and I think it's definitely sort of the next phase that we're seeing around, around a lot of the fintech space. Look, I think if you take the economic piece around what we think the global and U.S. economy are headed, there may be some shakeup, and there will likely be some shakeup around the fintech space and the asset finance space. But we think, frankly, those who are most well prepared internally, right, with getting your systems ready, getting your financing structures ready, getting all of that ready in light of whether it's public market issuance or other types of financial market or other activity, will leave these companies the most well prepared to survive post any recession.
Well, Henry, I have a follow-up question for you. Jake, a year or so ago at our Columbia conference, just talked about the securitization market and how competitive, from an investor's perspective, that is right now, which ties to the demand for yield. Curious, how you reconcile what you mentioned about the tepid loan growth globally, or at least in the U.S., with a combination of very rapid fintech growth. Like, how do you connect those two dots? And you can even maybe comment on how does that fit with the fintech and bank partnership model that you're starting to see as well?
Oh, absolutely. I think it's a great question because, again, it goes back to investor demand, right? Whether it's a more typical vanilla debt product or whether it's an ABS securitization product, that investor demand is strong and has been very strong for some time now. But at the same time, that loan growth from your traditional asset finance securitizer is not quite there. A lot of the fintechs are now coming in and taking and issuing and taking a lot of mind share for investors. So I think it's at this point it looks sort of symbiotic in the sense that you're moving away from your old line sort of asset finance firm doing their issuance to these fintech firms coupled with their bank partnerships to build volume. And so there is, there's benefits across all players here, and we're definitely seeing investors educating themselves and getting comfortable around some of those new asset classes, new fintech firms as servicers across these securitization products.
So one more follow-up question, and then I'm ask you the same question as well. How do you reconcile, a blunt way to put it would be the existence of fintech when fintech doesn't have the bank cost of capital and fintech is growing really quickly? How do you reconcile the existence of fintech with customer expectations? Why does fintech exist in your view?
That's a great question, and I think it comes down to customer service. It comes down to asset and expertise, and I basically bring it down to you've got banks, and banks are banks for a reason, right? They're well regulated. They've got tons of processes, but they take time to get things done, and often things like process, time, and bureaucracy impact a customer's need for financing. And I think fintechs have a very strong ability to be nimble, quick, and able to understand what customers need and what customers want, and sort of cut out a lot of the unnecessary piece, while also at this stage looking like they're protecting their own balance sheet or the balance sheet of their funding partners by putting on good loans. And that combination is always attractive in any market, right, where you can understand what the customer needs and satisfy them in a very quick way. Otherwise, if you're not doing that, then the low cost of capital will get you every time.
Well, thanks for answering that. And Anu, you've been doing this for a long time, 25 plus years. You sit at the top of a global financial services and technology company. What's your thoughts on that as you've seen the market evolve? Why do you think fintech exists, and how does that segue into asset growth and asset financing, growth of asset finance?
It's fascinating to sit here, as a part of Genpact and help some of our clients, which are largely banks, financial institutions, kind of looking to transform, and that's all aimed. How do you handle or how do you tackle, the growing competition from fintechs? I think in my view, really, companies across industries, they are really reinventing to stay relevant. And if you move to the next, page, you'll see the client expectation is changing. and the client expectation. I think Henry mentioned that as well. How can I get fast, flexible services? How do I make sure that what I get is seamless? I think those are a few changes that we are seeing as a shift which is happening in the client expectation. And that honestly has resulted, and now the industries and these companies are at that inflection point, and some of them who are ready to change and who are ready to actually adapt to the new world will probably leapfrog, and those who do not will get disrupted and will cease to exist. And I think there are several examples which we have seen over the last few years where those organizations have practically got wiped off because they just couldn't change fast enough, where some of the other companies totally outside of the industry were able to come in and disrupt them. Think of technology players like Amazon, Google. Think of their competitive differentiation. Now, cloud computing, AI, big data, those are very, very common. And I think that's really where, some of the banks and financial institutions have to be ready to adapt and quickly change and adapt to some of the upcoming technologies. And as banks respond to this competitive threat, I think the first noticeable change is going to be in increasing levels of deliverables, which they will require their providers like us. So when I go and meet up with customers, there's a shift in the client expectations. And for them, they tell us, give me more for less. They are very clear that I want to innovate. I want to leverage the upcoming technologies, digital technologies, and I want more predictability in my business. So they would like to use more analytics, would like to predict the future faster, get higher productivity gains. So I think those are definitely the changes which we are already seeing in the market from our customers. And I think that's all a result of the change from their end customers who are looking to get a seamless and a quick, customer experience.
And I have an interruption question for you. Can you go back one slide? So if customer expectations are changing and that's driving more for less, which makes sense in a lot of the industries that are listed here on this slide, how do you reconcile that in a commodity-based industry like capital, where ultimately we're talking about spread or cost of capital, and that's what the banks ultimately control? Like, how do you, in a system where you can't really manufacture for a cheaper price or outsource to China or do something to bring down your cost of goods sold, how do you reconcile customer expectations wanting more for less in the finance sector?
So we look at it in a couple of ways. I think one of the big ones obviously is how do you make sure that you link it back to what the outcome is which a customer is looking for. Ultimately, there is some outcome which the client is trying to drive, whether it's an outcome to bring down cost, whether cost to serve, whether it's an outcome to bring down the time to close for their end customers, whether it's to generate more leads, whether it's to get more repeat business. Ultimately, it has to link back into some outcome. And I think that's where we see, for our clients to stay competitive, they in turn will be looking at providers like us to be fast and have to respond quickly to those needs as well. And I think that goes in with the same logic which you will see in some of the other industries. So they will have to, react fast, and hence service partners like us have to react fast as well.
Thank you. Oh, we just had another question come in. How does Genpact assist with AI?
Awesome. I think we have a few thoughts. I'll probably share that in a couple of minutes when I walk you all through the journey of leasing and lending and how we see AI play a role there. But I think before I get there, I think I would like to speak on really clearly what is another significant shift, a paradigm shift that we are seeing. And that's really more about okay, great, now I have a great front office, it's all mobile enabled. How do I get that experience to translate into my middle office and back office? And I'll give you an example. Today in banks, financial institutions, I think majority of them now have mobile enabled front end wherein a customer is able to open up their accounts online, they're able to reach out and open up an application online. But guess what? Post that, it still goes back into a very heavily manual process, documentation, middle office, back office operation work. Thereby, it's kind of abruptly breaks that experience, and it's no longer that seamless experience that customer is looking for. So in other words, there is a disconnect between the front office, middle office, and back office. And what I'm seeing, I think one of the biggest opportunity area for banks and financial institutions is really to create that seamless experience. And I think if we move to the next slide, we will see that how we see this to be an opportunity, and that's really where banks can create that competitive edge for themselves.
I know another question just came in. Why is it that you mentioned mobile and digital on the front end? It's good to see that trend still coming through, but why is it that banks who are very large, very successful organizations still have paper processing on the back, to this picture, back 2/3 of their operation?
Very interesting question, and actually we did a study where we found that only 1 in 5 of our clients, so roughly about 20% of our customers, were able to really reap the benefits of digital investments. And I think the biggest reason which was coming out when we speak to our CXOs and even through the surveys, the biggest reason was, what we saw was, one, inability for the banks to move from multiple systems to one system, so very slow. Regulations was another big area which came up. Change management, while the senior leadership was all about, okay, let me change, let me get to the customers fast, let me get these middle office, back office connected, but that translation to the middle management layer was not fast enough. So change management was big. And I think lastly, which I'm sure is not unfamiliar with most of us, is the siloed functional organizations which banks or financial institutions continue to have. So it's very, very siloed. This is my credit organization. This is my operations organization. So that inability to connect the dots internally in the organization was another big reason which came out as a reason why the front office connects to the middle office and back office couldn't happen fast enough.
Thank you.
Okay. If we move to the next page, here I think there was a question earlier, how does Genpact see AI play a part? And I think what you see here is really a journey in any typical lease or a loan life cycle, from the time that lease or a loan originates to the time the end of the transaction happens. And I think in our view, there are several applicabilities of several of digital tools and technologies in this life cycle, and I've shared a few examples here. And if you see, majority of them are geared towards enhancing that experience of that customer. Taking a couple of examples, natural language processing, which is one of the AI-based technologies, at least we have been successfully using it in automating the financial spreading process, which is again using a lot of data, a lot of unstructured data, information from different sources, different systems, in different languages. How do you normalize that? How do you use that information and cut down the cycle time it takes to actually deliver those financial spreads, which by the way is used to underwrite transaction. And more importantly, how do you build accuracy and standardization, which is what regulators are looking for. So we are leveraging AI in several other ways. And another example which I see, which is again something that Genpact has been doing for some of our clients is on what we call as contract reconciliation. How do you make sure that what was written in the contract, the data which you have, is actually translated in your booking or servicing systems? You know, how do you extract that information, but more importantly, how do you reconcile into exactly the same terms which you have signed up? How do you make sure that we are following up and tracking that and not really leaving any income on the table? So apart from that, robotic process automation, several opportunities to automate some of the repetitive processes which are across the life cycle, and very simple workflows can solve some of those issues as well. So we have seen a lot of these digital tools play a very, very critical part, and we've seen that in play. I think important thing to remember is, you know, this is not recommending to change the underlying system. All these tools are actually working or recommended to work very well with the core technologies, core platforms which the organizations are using. And the biggest single objective is really in driving what we call as, you know, creating value across the chain, across the life cycle, whether it's in lead generation, increasing your percentage conversion, whether it's in improving cycle time so that the time to close is faster, or in making, you know, contract adherence being one of the key indicator, key outcome. So all of them are really geared towards really addressing one of these or all of these outcomes.
And you're going back to artificial intelligence for a minute. A question just came up. With respect to Genpact, obviously artificial intelligence is a buzzword in Silicon Valley right now. Is Genpact thinking about buying or building the latest and greatest in terms of AI technology?
We actually recently announced, which was about 4 months back, we actually announced acquisition of a very interesting organization, Rage Frameworks. It's an AI company. So we actually have already invested in artificial intelligence through this acquisition. But I think the way we are using AI is all about leveraging domain. With our history, with being a ex-GE Capital company, we are able to really leverage some of that domain to build the right tools and technologies for what the customers will use in asset finance.
And Henry, I'll kick that question to you now with your accelerator program, and then we're going to segue to Gary next. Henry, from your perspective, are you seeing any asset finance or maybe consumer finance companies that are really doing artificial intelligence with respect to specialty finance incredibly well?
Yeah, I think absolutely. There's some very strong ideas out there in the accelerator where I think especially around the consumer and small business space where data is just, you know, there's just more data to collect and there's more ability to use AI to parse through that data and really come up with good insights. So we're seeing it a lot. It's something that folks are definitely focused on in areas that are very data intensive. I think where the real differentiator we would see for folks is, or for some of these fintech firms, would be plugging it into sort of non-public data sources, right, and being able to get that from large institutions such as banks or otherwise who are able to sort of plug in their flow, whether it's consumer data or whether it's small business data, and really allow those systems to process that data and come up with good lending product or otherwise. And that's, I think, still burgeoning. I don't think there's too many of those large banks that sort of opened it up yet, but I think that could be a real interesting area.
So if you thought about going back a couple slides now, the front office, middle office, back office slide that Anu presented, where are you seeing the fintechs or the startups, pure startups, focusing their AI efforts, if you had to put it in one of those three buckets?
I would say what I see is mostly on the front office, right? I think it's mostly on the front office loan origination side. I'm definitely hearing from, and less of my conversations with clients, but more so perhaps with colleagues and partners of mine, definitely a lot of work in the back office, right? You know, I think, Charles, you made the comment about all the sort of manual processing, and I think it's just not been because it's not facing to clients, it's often thought of, you know, last, I would say, but it's an area ripe for change and where there could be a lot of opportunity.
So Gary, this is a great transition to you here, because you're both a very large manufacturer, distributor, and also a quote-unquote bank or finance company, and you have to be great at all of them in order to be successful. So with your perspective, we'd love to hear what you're thinking about the impact of fintech growth and asset finance, which hit both of your business models right in the middle.
Yeah, no, you're absolutely right. I think one of the things that that Henry mentioned early on when he spoke about this, Henry, you said something to the effect of the second phase of fintech, which I find compelling, because everyone wants to be in the fintech conversation since it started, and I think for me and for a lot of people, it's what conversation are you in? Because the industry is ripe with new ideas. In the last 2 or 3 years, how many of the fintechs have really accelerated to the degree where the business models are successful, and then what are we learning from them as traditional lenders? Whether you call us as Siemens an independent or a captive, or probably a little bit of both, but we do look across the transom at fintech platforms and say, what can we learn from there and how do we apply it? So to that end, if you jump to the next slide, Charles, I'll go through something that again that we think about. Yeah. So when we look at small business lending, why do I put this up there? Because one of the ways we think about this is in being in the conversation and what's the narrative. Is it Main Street versus Wall Street lending, right? So think about that just for a second. We as lenders, and I'll use our business model, we're not really, we Main Street lenders, we're down in that market where the ticket sizes may be smaller, but we're also primarily in middle market and larger ticket. And I think, for a lot of the folks on the phone, whether you're running fintech, whether you're running a traditional captive, whether you're running an independent, we're all across the board in terms of our appetite and size. But again, I look at it from Main Street versus Wall Street. And for me, in the perception of where I see the fintech impacting growth in asset finance, is probably in a sector that more is along the lines of Main Street. Maybe I'm wrong. But at the end of the day, I look at the markets and I say there's a huge chasm of access to capital that may be hampered by banking regulations, government and fiscal policy. And in that large spectrum of smaller businesses, there's a large opportunity for fintechs. And then
Gary,
how do I take? Yep.
Can you give us an idea of who your typical customer is?
Sure. Yeah. So we'll go anywhere from the SME all the way up to an institutional credit. So look at the industrial side. It could be an SME in the transportation, machine tool world. It could be on the larger side, multi-million-dollar transactions for institutional credits who may trade in the bond markets as well and issue debt there. So we're pretty wide. So that's why we have to pay attention to Main Street and Wall Street. And, Charles, in your point earlier about, in the search for margin, in the search for profitability, well, it's difficult to find the further you go up in terms of the Wall Street area. Margins are thin. So where can we optimize our business in the fintech side, maybe in the SMEs, probably bleeding edge into the middle tickets, and how do we optimize that part of our business to create speed, acceleration in the lending processes? And I think part of this dialogue also surrounded itself around front office, middle office, and I think Anu was talking about that, and she had a great depiction of that. Again, from my humble opinion, if I'm a revenue-generating business looking to delight customers in certain areas, I'm going to look to that, maybe the smaller side of the smaller tickets and the middle tickets, bleeding edge middle tickets, what I'll call the Main Street SMEs. Because my front office, if optimized correctly, I can delight the customer and I can accelerate the conversation, and I can probably onboard more customers and increase my revenue. And clearly the middle and back offices are equally as important, but it all starts for us at that front office and in that smaller mid-ticket lending. So, our digital roadmap and how we design it, really is focused on that area. But I think part of, and we can jump to the next slide, please. But I think, also part of what should be in the dialogue is not only our, we'll call it liquid expectations. Let's jump one more, actually, to the next slide. When we talk about liquid expectations and where do we look to find our experiences? Where do we look to find, our perceptual influencers? Well, every day we probably use a lot of, the Netflixes and the Amazons, but how much of that should bleed into my business world? How much of this should I really look at as a lender in all the markets that I'm in, how much of this should I really have to impact my business with and delighting my customers to give them a similar experience? I think some of that narrative is still developing. I think we all have an idea of what we think it is, and I think we would all go, yeah, it's got to be Amazon. It's got to be the Netflix experience. And everyone knows the Nordstrom, the history and the stories there. There's stories of you'll return snow tires if you bring it there. But again, at the end of the day, you have to find what business you're in, at least from my perspective. Focus on what your digital roadmap is from an asset finance of, is it my front end looking to my Main Street lenders and what markets am I in? But here's a final thought I'll add there. I mentioned early on when we got on the call, I talked about catalysts. I talked about solutions and performance-based outcomes. Part of where the fintech, I think, dialogue will go in asset finance is as the products change in asset finance, as new ways of developing models of how we sell the financing, the solution-based outcome, whether it's a machine tool, whether it's proximity printing, whether it's building tech on the smaller side, fire and security, how these things are sold on a performance-based outcome and a managed services agreement and anything of the like that's different from traditional lending will have to find its way into fintech. We'll have to be able to measure some of the performance of the assets through the value chain, through the term of the asset, and be able to report those back, I think, to be even more efficient and further develop this dialogue. It won't be as black and white and vanilla as it is today.
Hey, Gary, you have such an interesting cross-section of your customers and then also as your business as well from finance and manufacturing perspective. How is the overall health of your customer? And I have a follow-up question for that, but are they bullish, are they bearish, are they just waiting to see what the administration does? What do you think?
Well, we're in such disparate type businesses over here. The industrial sides are more the SME model. So, you ebb and flow from a cash flow standpoint, depending on, how the economy ticks on every given day. Point to housing starts and some of the construction information you get, how raw goods are moved. A big part of our portfolio will move upon that, upon those triggers. But there's a large portion of our portfolio that really is much different. It's fiscal policy, what the administration is doing. There's a healthcare piece that we're in. That's an unknown. What happens in the healthcare space? Will hospitals, will practitioners buy the next generation equipment? Will they delay it? Can they pay for it? We don't see hospitals going out of business, but what you will see is, and my belief is, that there'll be a different model in the future for both how they acquire equipment and how the consolidation in the healthcare space continues. Large hospitals will collapse into, single entities. I think we'll see much larger, broader hospital footprints owned in a chain versus, 2 or 3 hospitals, more IDNs. So we're in different businesses, and again, what I'll come back to is in the SME market, yeah, every day you have to kind of check yourself at the door and understand where, where today's markets are and how consumers are spending. The other part of the portfolio is larger. Yep, go ahead, I'm sorry.
So with your SME customers, I think Amazon, Uber, Netflix, Apple, we all use those customers, Google. Those are very consumer-facing businesses and very tech, mobile-oriented businesses. But with respect to your portfolio, are your customers using technology in their businesses? Maybe it's not fintech, it's the wrong word, but are they just using technology to improve the experience of their customers? Do you have any insight into that?
Yeah, some are, in different ways, Charles. SMEs will use technology, maybe not even to impact their customers, but maybe to optimize their own businesses. Whether it's a transportation company or a logistics provider, and it doesn't necessarily need to be a company with 10 million in revenue. It could be, a transportation company with a, 50 to 100 million in revenue in that space. But they're all using technology to optimize their businesses, and as an end result, it should end up delighting their customers and impact their customers with better outcomes.
A segue question from that is purchasing decisions. I think it's always a nagging question in the back of all of our mind in the asset purchasing finance market is when, if, will Amazon ever enter into our market? And so from your customers, let's take a hospital as example, are they changing their behavior of how they buy equipment or who's actually purchasing the equipment? Are they using mobile, are they doing things differently, or is it too early to tell?
Well, I don't think it's too early to tell. I mean, you go back to the, I hate to use it, but the old, Miller-Hyman approach where it's, coach, user, technical, and financial buyers. or economic. At the end of the day, you know, the larger the purchase, there's going to be some type of financial decision maker. I think all the colleagues on the phone around the country and all our finance companies would agree. You know, you're making large asset purchases. They're going to be on the balance sheet or off the balance sheet for the next 5 or 6 years that are 7 figures. You better bet there's going to be a financial person influencing that decision. I think the further we go downstream, whether it's a small modality equipment in the healthcare setting, whether it's a machine tool or transportation units, I think, you know, there you could probably rely on some technical users without a financial coach in the middle of that buying decision. It could be more of an operating expense. So I think for us it's fragmented. Depends on the business model, but for us it's a little bit different. We do see both.
Would you say it's more driven by the dollar amount or by the purchase type?
I think it's, well, I hate to say it's both, but it's probably a little bit of both. You know, the larger, the more complex and more technical the asset, you know, obviously there's going to be a technical influence on that. You know, I'll use the healthcare example again. If it's a CT that's going to run a number of scans and has the next generation technology, or it's proton therapy, there's going to be a technical influence there. However, if that asset is $2.5 million, we're sure going to bet that there's going to be a financial person with oversight saying, hey, how's that impacting our balance sheet? How's that structured? If I go downstream and it's a, you know, whether it's a machine tool or some type of 3D printing or something like that, or maybe even software that we finance for some of the businesses. You know, I think that could be more of along the lines of a single user experience. It's the technical buyer saying, hey, how will this impact my business? Because the price point isn't as large enough to make a significant difference in the discussion, I think.
You know, that's a question just came in for Anu, and this has to do with the same topic. Anu, what are your thoughts on who and how banks are making decisions about what product, when they purchase, call it fintech equipment or fintech technology, who in the bank is making that decision?
This is a great question, because we have actually seen this change over time. You know, earlier this used to be a typical purchasing, you know, or sourcing organizations, you know, discussions, but we see more and more, you know, chief, and this is not even a chief IT officer's decision. This is becoming more of an operating organization's decision, business leader discussion. So we are seeing more and more involvement from the business heads, business leaders, versus sourcing organizations, which typically was the case earlier.
Well, thanks for answering that. I want to keep going, but every time we get to one of these CEMC conversations, I always leave inspired. I hope you made it to our Innovation Summit in June. If you didn't, please come next year. It was a really amazing experience for me personally. And just to remind each of us that this is an invite-only community, and the only requirement to get into the community is a common belief or interest that the world is being changed by technology, and really asset purchase and asset finance is the driver of that technology. As we just covered a wide array of sectors today and industries. I hope this was a good use of your time. Thank you very much to our panelists. Thank you very much for your time.